Welcome to the Deep Dive. We're here to cut through all that noise from complex reports and really get straight to the insights you need. Because navigating financial statements, strategic announcements, sometimes it feels like looking for a needle in a digital haystack. But that's what we do here. Today, we are diving deep into the latest from Paychex Inc. We're looking at their fiscal year 2025 results and also their huge strategic move acquiring Paycor HCM. Our mission, simple, give you a clear, concise understanding of how Paychex did, the real impact of this big acquisition, and what to maybe expect next year. We'll use facts, context, drawing straight from their earnings report, and also an independent investment analysis. Okay, so let's unpack this. Paychex just dropped their fiscal year 2025 results. Looking at them, what are the headlines that really jump out first? Well, for the full fiscal year, the top line, total revenue increased by 6%. That brings it to $5.6 billion. But it's really critical here to distinguish between their U.S. GAAP figures, generally accepted accounting principles, and their adjusted figures. Right. The adjusted ones often paint a clearer operational picture.
Exactly. They strip out things like one-time costs, maybe from the acquisition itself. And when you look at those adjusted numbers, adjusted operating income grew by 7%, and adjusted diluted earnings per share, that grew by 6%. So that gives you a much more, let's say, consistent growth story. Positive.
That distinction is key, isn't it, for really understanding what's going on. And something that really caught my eye was an independent analysis from Investing Pro. They pointed out Paychex didn't just meet analyst expectations for Q4 earnings and revenue, but they did it while keeping these, frankly, impressive gross profit margins, 72%.
Yeah, that's high.
And a robust 44% return on equity. Plus, they've raised dividends consistently, 11 years straight. How did those metrics kind of fit together for you?
It's pretty compelling how they intertwine. I mean, a 72% gross margin, especially in a competitive field like HCM, it suggests real pricing power or maybe just exceptional efficiency. It's not just that they met expectations, it's how, right? Combine that with the strong ROE, the dividend history. It really paints a picture of deep financial discipline, a strong competitive position. They're consistently profitable at the core. And that lets them return value to shareholders even while they're making these big growth investments.
So when you hear those numbers,
Yeah.
high margins, steady growth, those dividend increases, what does that really say to you about how Paychex is handling the dynamic market conditions we're all seeing?
Okay, so with these solid results, the big question is, what's next? And a massive part of that story has to be the completed acquisition of Paycor. How fundamentally does this reshape Paychex? Oh, it's truly transformative. I mean, the CEO himself said it positions Paychex better than ever before for success in this digital and AI-driven era of human capital management. It's not just about getting bigger, though. It specifically boosts their capabilities upmarket. So serving larger enterprise clients more effectively now.
Ah,
It expands their total addressable market. The whole pool of customers they can now target enhances their partner network, and crucially, gives them huge additional opportunity for cross-sell.
cross-selling into that new Paycor base.
Exactly. It's a very strategic move to meet how businesses' HR needs are changing, with all this digitization.
And it sounds like they're moving quickly on the integration. Tell us about that process. Seemed pretty aggressive.
They've made incredibly rapid progress, yeah. The company is now, as they put it, operating as one Paychex. They've already laid out the new platform focus, Paychex Flex for companies up to 99 employees. The Paycor platform targets that upmarket enterprise segment, so 100 employees and up. And SurePayroll keeps serving the small business do-it-yourself market.
Okay, clear segmentation.
Right. And that required a huge effort, territory assessments, reassignments across sales teams, plus comprehensive training for reps on the whole combined suite of solutions. They did acknowledge this caused some internal disruption in Q4. It took, quote, many of our sales resources out of the field.
That's a bold move, pulling people out of the field.
It was, but they called it a strategic decision to speed up integration. Basically short-term pain for long-term gain, in their view.
Interesting they'd accept that disruption for speed. So beyond the operational shifts, what about the financial side? The synergies.
Right.
What are they expecting? Cost and revenue.
Well, on the cost side, they actually raised their expectations. They're now targeting about $90 million in cost synergies for fiscal 26. And they stated that the actions already taken give us high confidence in hitting that number. So they seem pretty sure about the cost saving.
90 million, okay. And revenue.
Revenue synergies, they expect those to add about 30 to 50 basis points to total revenue growth in fiscal 26.
So 0.3 to 0.5% additional growth from synergies.
Precisely. And they expect that contribution to build over the next several years. The biggest chunk of that is the cross-sell opportunity, right? Selling Paychex's retirement, ASO, and PEO solutions into that Paycor base of over 50,000 clients. And they've already got some early wins. They mentioned securing their first Paycor clients on ASO and PEO, including, interestingly, a PEO sale referred by a Paycor broker before the product was even officially launched to that client base.
Wow, that's a strong early signal. That actually brings up another point. How are these new channel partner programs fitting into this whole growth and integration strategy?
Yeah, they've really leaned into the channel aspect. They launched the Paychex Partner Plus program for brokers, already got over 1,000 enrolled. And there's the Paychex Partner Pro platform for accountants. This isn't just, fluff. Referrals are critical for them.
How critical.
They said more than half of their new business originates from channel partner referrals. So nurturing these broker and accountant relationships is key to feeding the pipeline, especially now with the expanded Paycor base and more solutions to offer.
Makes sense. Okay, let's dig into the segments. How did the different parts of the business perform driving these overall numbers?
Sure. So management solutions, think payroll, core HR, its revenue was up 12% in the fourth quarter. Now, a lot of that was the addition of Paycor, but also higher revenue per existing client through price realization and product penetration.
And without Paycor, what was the organic growth there?
Good question. Excluding the acquisition, management solutions revenue still grew about 3%, so
Yeah.
still seeing some underlying organic traction. Then you have PEO and insurance solutions. Revenue there increased 4% for Q4, mostly due to growth in the average number of PEO worksite employees and higher PEO insurance revenues.
You mentioned PEO, but tell us a bit more about that segment. They flagged some specific, maybe challenges or nuances there.
Yeah, it's a bit nuanced. The overall PEO business, they stressed, continues to perform well, good growth in worksite employees, but they did face what they called a pass-through revenue headwind.
Pass-through headwind, what does that mean exactly?
Think of it like this. Sometimes Paychex handles money that just passes through them for specific client needs, maybe like certain medical plans. If enrollment in, say, their Florida at-risk medical plan decreases, or if employees choose cheaper health plans, less money passes through. But, and this is the key point they made, these factors do not impact their earnings or their PEO value proposition.
Ah, okay, so it affects the top-line revenue number because less money is flowing through, but not the actual profit or the core service value.
Exactly. The core benefit of PEO letting small businesses offer big company benefits that remain strong, it just looks a bit different on the revenue line sometimes. And one other item, interest on funds held for clients. That was up 18% in Q4, mainly because they now hold Paycor client funds too.
Got it. So with all these moving parts, the big acquisition, the investments, what did that do to overall expenses and profitability?
Well, total expenses did jump 22% in the fourth quarter, but that was primarily driven by those acquisition-related costs associated with Paycor, things like compensation, professional service fees for the integration, and also their continued investment in product, technology, data, and AI.
But if you strip out the acquisition costs,
Right. If you exclude the Paycor acquisition impact, total expenses only increased 1% for the quarter.
only 1%. Okay, that really isolates the impact.
It does. It highlights that the big jump in reported expenses is really about integrating Paycor and making strategic investments, not some underlying cost blowout.
So stepping back from the operations, what does their overall financial position look like now? After taking on Paycor, are they still on solid ground? Maybe stretched a bit thin?
Definitely still on solid ground. At the end of fiscal 2025, their cash, restricted cash, and total corporate investments totaled $1.7 billion. And cash flow from operations for the full year was strong, $2.0 billion. That shows a really powerful underlying ability to generate cash.
$2 billion in operating cash flow. That's significant. But it raises the question, right? How are they balancing these big investments like Paycor with returning value to shareholders? Especially since they took on debt for the deal.
That's a key balancing act. Total borrowings did increase significantly, up $4.1 billion to $5.0 billion, mostly to finance Paycor.
Okay, that's a big jump in debt.
It is. But despite that, Paychex still returned over $1.5 billion to shareholders during the fiscal year, primarily dividends, $1.4 billion total, plus about $104 million in share buybacks. And their annual return on equity, even after the deal, remains robust at 42%. That's very impressive.
42% ROE post-acquisition. Wow.
Yeah. And they also signaled they expect to deleverage fairly quickly, pay down that debt, mostly using the extra earnings, the incremental EBITDA from Paycor, and also by paying down the debt that's maturing in the next year. It really shows a disciplined approach, managing debt while still rewarding shareholders, even with a huge deal like this.
Okay, let's shift to the outlook, the crystal ball moment. What are they saying about the broader economy, and how's that feeding into their forecast for fiscal 2026?
Well, the CEO described the environment as a mix of both optimism and uncertainty. He said many businesses feel kind of frozen, waiting for clarity on big macro issues, tariffs, inflation, taxes, you name it,
Sounds familiar.
doesn't it? Now, their own small business employment watch showed stable job levels, no signs of recession. But they did see an uptick in bankruptcies and financial distress, particularly at the micro end of the market in Q4. Also, more clients being lost due to mergers or business combinations, so it's a complex picture out there.
And how did the market react to all this?
Interestingly, even though Paychex met earnings expectations, the stock took a notable hit in pre-market trading, down about 7.65%.
Despite meeting expectations.
Yeah, it suggests maybe less about Paychex specifically and more about that broader investor caution, the macro uncertainties we just talked about. Plus, that Investing Pro analysis did suggest the stock seemed maybe slightly overvalued at current levels.
Fascinating disconnect there. Strong performance, but market jitters. So how are they translating all this, the mixed signals, the market reaction, into actual guidance for fiscal 26?
Okay, so their business outlook for fiscal 2026, and this notably excludes those acquisition-related costs we discussed.
Right, the adjusted view again.
Exactly. They anticipate total revenue growth between 16.5% and 18.5%. Now, Paycor itself is expected to contribute about 12 to 13 percentage points of that, and those revenue synergies we talked about, another 30 to 50 basis points or 0.3% to 0.5%.
Okay, so significant contribution from Paycor plus a bit from synergies on top of their base organic growth.
Correct. Adjusted diluted earnings per share, they expect that to grow between 8.5% and 10.5%. Management Solutions revenue growth projected at 20% to 22%. PEO and Insurance Solutions 6% to 8% growth, but they expect that to accelerate in the back half of the year as they lap some of those headwinds we mentioned earlier.
And margin.
The adjusted operating margin anticipated around 43%.
43% adjusted operating margin.
Sure.
Okay. So when you look at that guidance package, what does it really mean for you, the listener, trying to understand where you're headed?
I think it strikes a balance. It feels like a blend of maybe conservatism, given the macro uncertainty, but also underlying optimism about the integration and their market position. The CFO described it as a gradual buildup of growth over several years, not some immediate explosion. It really underscores their commitment to sustainable growth efficiency, especially in this AI-driven era.
And the decision to invest fully in all three platforms, Paycor,
Yeah.
Flex, SurePayroll.
Right, shows commitment to that dual platform strategy. They also reiterated, remember, that Q4 sales disruption, that it was a deliberate strategic decision to speed up integration. And they said the organic growth slowdown was due to tougher comparisons and those headwinds, but the underlying exit rate from Q4 actually aligns pretty well with their organic growth expectations for fiscal 26. So it signals a long-term strategic focus.
Okay, so wrapping up this deep dive on Paychex. Yeah. We've seen a company delivering solid financials, yes, but also one going through this massive strategic change, integrating a huge acquisition, all while navigating pretty complex market conditions.
Yeah, I think the key takeaways are strong underlying performance in fiscal 25, really boosted by strategic investments and obviously the huge Paycor acquisition. Despite, some short-term market jitters and the unavoidable disruption from integration, management seems really confident they can hit those long-term synergy targets and find growth. They're balancing integration complexity with that disciplined focus on profitable growth.
So hopefully you've just gotten a shortcut to being really well informed on Paychex's latest moves, a clear picture of the numbers, the strategy, and the nuances that actually matter. And maybe a final thought for you to consider. As Paychex integrates Paycor, as they aim for that double-digit growth, how will this dual platform strategy flex for smaller businesses, Paycor for the bigger enterprise clients? How might that redefine the whole human capital management landscape? And what could that mean for the future of HR solutions for businesses like yours?